Sorry, today was Rishi Sunak's first Prime Minister's Question Time, and here you can see photographs from the BBC 6 o'clock news of Rishi's supporters doing very well, as in they've all been promoted to the cabinet or kept their cabinet positions. The big thing, really, though, is there was an announcement about whether or not there would be a new budget, and that's going to be, it was supposed to be on the 31st of October. It's going to be on the 14th of November instead. One of the interesting things that's going to happen is, of course, there's going to be massive austerity. Absolutely enormous austerity is going to come because the UK is in a lot of debt. There were two articles that appeared in the FT today and yesterday, one by Nicholas Dunbar, editor of Risky Finance and author of various books, including The Devil's Derivatives and Inventing Money, about derivatives. And he said that there are lots of government bonds that are index linked, as in they pay out based on the inflation that the UK experiences. Now, these have been coming out since the 80s, and there's been a period of low inflation until recently. So now that inflation is going up, it means that those bonds, basically it costs the government more to have issued those bonds. They have to pay out every 6 months or something like that coupons, but the total value that they have to pay at the end of the term of the bond, that goes up. Now, how is the impact of that measured? That's measured by the Office of National Statistics, that rely on forecast from the Office of Budget Responsibility, which themselves use figures that are given to them by the Monetary Policy Committee of the Bank of England. And according to Nick Dunbar, the Monetary Policy Committee of the Bank of England have been getting inflation wrong. They've been thinking that inflation will go down after 2023, and financial markets don't really think that. Now, this means that essentially the amount of interest that Britain has to pay on its bonds altogether, including the massive chunk for index-linked bonds that are linked to inflation, that's basically going to be about 100 billion a year for the next 10 years. At the moment, it's 92 billion, of which the total UK debt repayments are 92 billion a year, and of that, 55 billion are linked to inflation. So that's only going to go up. So this means that the austerity that's going to come on the 14th of November is going to be absolutely massive, because the previous budget from Kwasi Kwarteng, he didn't use the OBR, and it meant that markets didn't really know how he was going to fund his tax cuts for the rich. This time, Jeremy Hunt is basically going to say, well, everything is costed, but we have to spend less. So the idea is he may raise taxes and he may cut spending. That's going to be terrible for the UK. That's one story. So yeah, basically, also even in America, they've issued these index-linked bonds, and apparently over there, it's because in the UK, index-linked bonds are only 25% of bonds that have been issued, but they're about 60% of repayments, and that's probably going to go up. In America, I think they're half the repayments. It's something like 55 billion, but the fraction is only 9% of bonds that have been released. The other story was Josephine Cumbo of the FT, a pensions journalist, had interviewed someone who is high up in an asset manager called Amundi. So whereas Nicholas Dunbar was talking about the risk to government finances, Amundi, the Amundi asset manager, was talking about the exposure to leverage. So basically you have defined benefit pensions, which essentially pay people a very generous pension, and that's basically inflation-proof pensions. So they're all index linked. Now, in order for insurance companies, pensions, and asset managers to do the right investments that will provide those yields, they rely on derivatives to provide leverage. Now, let's say they had 50 billion, they would use derivatives to make it feel as though they had an exposure of 150 billion. The problem is that when you have jitters in the market, like with Kwasi Kwarteng's budget, that then means that the bonds that these types of asset managers hold, they underperform. And when they underperform, they have a knock-on effect on their derivative holdings, because the people that they've taken out derivatives with say your overall assets are worth less, so we quickly need more money to cover your positions. Because that's what happens if you're going to use derivatives in order to operate in financial markets. When there are changes in values in markets, you have to make up the difference, because you have to, what they call, provide collateral. And so when you have these shocks, the collateral demands go up, which means you have to sell what you've got in order to be able to reduce the collateral that you need or provide the collateral that you need. And this has a knock-on effect, and essentially there's a vicious cycle. So the Bank of England had to step in because of the way in which pension funds and asset managers were operating in order to meet their derivatives demands. And in the end, the Bank of England came in and started buying pensions. But they said they would only do that for a few days. So essentially what the man from Amundi is saying is that whereas previously it was banks that would be buying a lot of these products, now it's pension funds, and they're all using derivatives. And the problem is, whereas banks are easy to observe because they're all highly regulated, these asset managers, pension funds, insurance companies, and hedge funds, basically you could call it shadow banking because they don't have to follow banking regulation. They are much harder to track. So that means that when you have a problem, it's very difficult to know where the problems are, where the future risks are, because a lot of these organizations are not transparent. So we don't really know what they're holding, what their portfolio is, and what the impact would be of economic shocks on these types of organizations. And so how can you take safeguards against a future problem if you don't really know where all of the risks are? So yeah, as I said, that's two stories. One was Nick Dunbar talking about the risk to public finances of index-linked bonds, basically the exposure to inflation. And then the other one was the FT article about the enormous amounts of risk in the financial system because of the increase in shadow banking in proportion to normal banking. And so whereas at least normal banking can be regulated and people can see what's going on, with shadow banking you can't.